Frank was 74 years old and had lived in the same three-bedroom house for 41 years. It was paid off, completely, free and clear, no mortgage, nothing owed to anybody. And Frank was also 6 months behind on his property taxes, skipping pills some months to make the electric bill, and telling his daughter he was doing fine every single Sunday on the phone. Here's the part that should make you angry. The whole time Frank was rationing his medication, he was sitting on $210,000 of equity in that house. Money that was already his. Not a loan he had to qualify for from scratch. Not a favor from anybody. His own money, locked inside four walls, and nobody had ever sat him down and shown him how to get to it without selling the house his wife died in. Frank is not rare. Right now, homeowners over 62 in this country are sitting on an average of $180,000 in equity they never touch. Not because they don't need it, not because it isn't theirs, but because almost nobody has ever explained in plain English the three specific ways to unlock that money without selling, without moving, and without handing the house over to anybody. Stay with me, because that is exactly what I'm going to hand you today. 3 real ways to turn a paid-off house, or even a house you still owe a little on, into cash you can actually use. One of them can hand you a lump sum in about 30 days. One of them can wipe out a bill you're paying every single year for the rest of your life. And the third is a growing line of credit that a huge number of seniors are convinced they don't qualify for, and they are flat wrong. By the time this video is over, you are going to know exactly what these 3 are, who really qualifies, the one mistake that makes people count themselves out when they shouldn't, and the precise first step to take this week. First, let me tell you who I am, because you should know that before you trust a word of this. My name is your name. And for the last several years, I have worked directly with homeowners over 62, sitting at kitchen tables, going through deeds, tax bills, and loan paperwork, helping them find money that was already theirs and nobody had ever pointed them to. I am not selling you a house. I am not a real estate agent trying to get you to move. Everything I'm about to walk you through, I've watched work for people exactly like Frank. Here's how this is going to go. I'll take these 3, one at a time, in plain English, no jargon left unexplained. For each one, I'll tell you what it actually is, who really qualifies, the real numbers, and the exact first move to make. Let's start with the biggest one. Unlock number 1, the federally insured reverse mortgage, and the feature nobody explains. You've probably heard the words reverse mortgage before, and if you're like most people, what you heard scared you. Some story about the bank taking the house. Let me clear that up right now, because it is the single biggest reason people over 62 walk away from $180,000 that was never at risk in the first place. A federally insured reverse mortgage, the technical name is a home equity conversion mortgage, most people just call it a HECM, is not the bank taking your house. You keep the title, you keep your name on the deed, your kids can still inherit the home. What actually happens is simple. Instead of you making a payment to the bank every month, the bank makes a payment to you, using the equity you already built. And the loan is not due until you sell the home, move out permanently, or pass away. Here's the part that matters most, and it's the part almost nobody explains. There isn't just one way to take that money. You can take it as a lump sum. You can take it as a monthly check, like a second pension, for as long as you live in the home. Or, and this is the piece that gets skipped every single time, you can take it as a growing line of credit that you only draw from when you actually need it. That third option is the one I want you to remember, because it has a feature that sounds almost too good to be true, and it's completely real. The unused portion of that credit line grows over time. Not the value of your house, the actual amount of money still available to you gets bigger every year you don't use it, regardless of what home prices do. I have shown this exact chart to people who read it 3 times because they assumed I made a typo. Let me translate why that matters. Most people are told to wait as long as possible to touch their equity, just in case. With a reverse mortgage line of credit, waiting is actually the strategy that works in your favor, because every year you don't draw on it, the available credit grows. It is one of the only financial tools built for seniors where doing nothing quietly makes you richer. Now let me tell you who actually qualifies, because this is where most people count themselves out for no reason. You need to be 62 or older. You need meaningful equity in the home. Generally, you should own it outright or have a small remaining balance. And you need to be able to keep up with property taxes, homeowners insurance, and basic upkeep, because those don't go away. That's it. You do not need perfect credit. You do not need a certain income. This is not a loan that judges you the way a regular mortgage does, because it isn't measuring your ability to make a payment. You're not making one. Let me tell you about Eleanor, because her situation is the one I see most often. Eleanor was 68, widowed 2 years, living alone in a house she and her husband bought in 1988. It was worth about $340,000, and she owed nothing on it. Eleanor's fixed income covered her bills, barely, but there was nothing left over for the roof that needed replacing or the trip to see her grandkids in Colorado she'd been putting off for 3 years. Eleanor set up a reverse mortgage line of credit for roughly $150,000 of her equity. She has drawn maybe $20,000 of it so far: the roof, the flight, a new furnace. The rest sits there, growing, untouched, waiting for the day she actually needs it. Same house, same neighborhood, same name on the deed. She just stopped being cash poor while sitting on a paid-off house. If you remember one thing from this entire video, remember this. The house is not the only asset you have. The equity trapped inside it is a second asset, sitting right next to the first one, and almost nobody ever shows people how to split the two apart. Unlock number 2, the Property Tax Deferral Program. Almost no one applies for. Now let's talk about a bill you are very likely paying every single year that, in most states, you don't actually have to pay. Not because you're breaking a rule, but because there is a program specifically built to let you defer it. Here's the part that is genuinely maddening. The majority of states have some version of a senior property tax deferral or freeze program, and study after study finds that a huge share of eligible seniors never apply. Not because they don't qualify, because nobody ever put the application in front of them. Let me translate what deferral actually means, because the word alone stops people from looking into it. A deferral does not mean the tax disappears. It means the state or county allows you to stop paying it out of pocket right now, and instead the amount gets attached to the home as a low-interest lien that is settled later, usually when the home is eventually sold or passes to your estate. In the meantime, that money stays in your pocket every single year instead of going out the door in a check to the county. For a lot of seniors, we're talking about $2,000 to $6,000 a year staying in their bank account instead of leaving it, every single year for as long as they stay in the home. Some states go even further and freeze the assessed value of your home entirely once you hit a certain age, so your tax bill stops climbing even while your neighbor's bills keep going up. Who actually qualifies? Almost every version of this program requires you to be a certain age, usually 65 and up, though some start at 62. Most require the home to be your primary residence. Many have an income cap, but here's the detail that surprises people. That cap is often higher than they assume, because it's measuring your income, not the value of your house. I have seen homeowners with a fully paid-off $400,000 house qualify easily because the program is testing what's coming in every month, not what the house is worth on paper. Picture a retired couple, both collecting Social Security, watching the property tax bill climb every single year while their income stays exactly the same. That gap, rising bill, flat income, is precisely the gap these programs exist to close. One form, filed with the county assessor's office, and that climbing bill either freezes in place or stops being an out-of-pocket expense altogether. Here's the part I really want you to remember before we move to the third one. This program is state and often county-specific, which means the exact name, the exact income limit, and the exact deadline are different depending on where you live. That is exactly why almost nobody uses it. There's no single national headline announcing it, so it just sits quietly on a county website that nobody thinks to check. The move here isn't complicated. It's one search: your county name plus Senior Property Tax Deferral, or one phone call to your county assessor's office asking directly, "What senior tax relief programs do you offer?" That single sentence, said out loud to the right office, is the whole unlock. Unlock number 3, the single-purpose loan nobody talks about. This is the one I told you about at the start, the one that hands you money the fastest, and the one almost nobody has heard of, because it doesn't have a flashy name and it isn't marketed the way a full reverse mortgage is. It's usually called a deferred payment loan or a single-purpose reverse mortgage, and it exists at the state and local level, often run by housing authorities or nonprofit agencies rather than banks. Here's what makes it different from everything else we've covered today. It is designed for one very specific thing: home repairs, accessibility modifications, or paying off a tax lien. And because it's narrow, it moves fast, and it's often at little or no interest. Let me translate that. If your roof is failing, your furnace is dying, or you need a ramp and a walk-in shower to safely stay in your own home, this is frequently the fastest money on this entire list. We're talking weeks, not months, and in many programs, the loan doesn't have to be repaid at all until the home is sold or the homeowner passes away. Similar in spirit to the reverse mortgage, but built specifically to fix the house you're already living in rather than to supplement your monthly income. Who qualifies? This varies by program more than the other two, but generally you need to be a senior homeowner, usually with a documented specific need: the repair, the modification, the tax bill, and often there's an income limit that skews toward moderate and lower income homeowners, which makes this the option most likely to help the people who need it most and can least afford a traditional loan. I want you to picture Raymond. Raymond was 71, and the furnace in his house had been out for 3 weeks in November. He was using space heaters and telling himself it was fine. Raymond did not know a program existed that would put in a working furnace and not ask him for a single payment until the house eventually sold. One call to his local area agency on aging led him to it. Same furnace repair a contractor had quoted him $6,400 for, out of pocket, cost him nothing that winter. Here's the truth underneath all three of these. None of this is charity. None of this is a handout. This is money and programs that already exist, funded and waiting, built specifically for homeowners exactly like you. The only reason $180,000 sits untouched in the average senior homeowner's house is that these three paths were never laid out together, in one place, in plain English. Today, they were. This is general education, not financial, tax, or legal advice for your specific situation. Every program mentioned here has different rules depending on your state, your county, and your individual finances. So before you act on any of these, confirm the specific numbers with a HUD-approved reverse mortgage counselor for the federal program, with your county assessor's office for the tax deferral, and with your local area agency on aging for the repair loan. But do not let that stop you from making the calls, because the homeowners who ask are the ones who get the money, and the ones who never ask are the ones who keep rationing pills in a paid-off house. So here is exactly what to do this week. For the reverse mortgage line of credit, call a HUD-approved counselor. This counseling session is required by law before you can move forward. It's not a sales call, and it typically costs very little or nothing. For the property tax deferral, call your county assessor's office and ask the one sentence I gave you earlier. And for the repair loan, search your state name plus area agency on aging and ask what home repair assistance programs exist for seniors. 3 phone calls. None of them take more than 20 minutes. And on the other side of those calls is money that is already yours, sitting inside a house you've probably lived in for decades, waiting for someone to finally show you where it was. If this opened your eyes, do one thing for me. Share it with someone you love who is 62 or older, especially anyone sitting on a paid-off home and telling everyone they're doing fine. They may be sitting on $180,000 they have never once heard about, and they are the least likely person to ever go looking for it. You can be the reason they finally do. Subscribe, turn on the bell so the next one finds you, and I will see you in the next video.